how some fixed indexed annuities work. Most importantly, the surrender charges and the withdrawal charges and the withdrawal fees. I wanted to show you three common types of terms: a 5-year term annuity, a 7-year term annuity, and a 10-year term annuities, only looking at just the surrender fee schedules and how withdrawals work as well, any additional fees. As always, educational only, not financial, tax, or legal advice, simply education to see. The first one I want to show you over here is in the top left. This is a 10-year annuity, meaning if you, at the end of the 10 years is done, you can take the entire annuity out without any surrender fees or charges. There's also a 7-year and a 5-year, same thing as well. Once the entire term is completed on there, then you can take out the money from the annuity and do something out with it if you want, or leave it in the annuity. Now, on this 10-year one here, you'll see it has a surrender charge schedule. So in contract year 1, all the way down to contract year 10. In the earlier years, the surrender charge is higher, as opposed to the later years, it is lower. Now, most fixed index annuity companies let you take out 7 to 10% of the account value as a withdrawal without fees every anniversary year. So again, most fixed index annuity companies let you take out 7 to 10% of your account value every anniversary year without fees. By that I mean on here is, let's say we take 10% as our example, using the 10-year product over on here. Let's say if we were in year 3, you see a surrender charge percentage of 12%. However, you can take out 10% of the account value if you want to, and there's no surrender charge fee for that. However, in that same 3-year example on the 10-year, if you took out 14% of the account value, well, because 10% is the free amount, you took out 14, so you took out 4% extra. The extra 4% amount you took out will receive a 12% penalty on the extra 4% because it's more than that 10% free withdrawal limit. Now, let's look over here at the 5-year on the top right area. So there's only a 5-year contract, so we see there's 5 years for that. Well, let's use a different example. Let's say come year 3, some life event happens, who knows what goes on, and you have to cancel the entire contract. So the whole contract gets terminated. Well, if you cancel the entire contract, your entire account value would have a 7% fee for canceling the contract early. Now, just to read on here too, the surrender value is the contract value less any applicable withdrawal charges after any applicable market value adjustments and less any applicable premium or taxes, or the minimum non-forfeiture amount. Now, the withdrawals, it's any withdrawal of a portion of a contract value might be subject to charges. Now, again, you have that free withdrawal that doesn't get the additional charges on there. Now, in the bottom down here, this is a 7-year annuity, so it's a 7-year contract term. Now, I wanted to read what the bottom says on there. Surrender charge period, the period of the contract during which surrender charges apply to full or partial withdrawals that exceed the free withdrawal amount. So again, if you can withdraw up to 10% every anniversary year, there is no surrender charge on that free withdrawal amount. It's only anything above that free withdrawal amount, in this case 10%, would receive a surrender charge on there. So that is why it's so important when we design annuities here at our firm and with our clients, only if it's appropriate and only if it's best for their own financial plan, that we look at annuities as one tactical component in addition to stocks, ETFs, mutual funds, bonds, real estate, and so much more. The biggest cons, as always, are liquidity. If someone's going to have a huge liquidity need or a huge expense need during the term of these annuities, I would almost never use an annuity because we know they're going to need a large cash flow in the future, or we know they're going to have a large expense in the future. We don't want to put them in an annuity because that's going to cost them so much fees and losing account value that those are many cases out there that we don't want to use those kind of fees for them. So as always, be aware of all the fees involved. Be aware of surrender charges. Be aware of your free withdrawal limit. Be aware of the terms you have with annuities as well. This is just one component that's in a contract of the annuities. There's other components that if your annuity gives you a bonus, as an example, there's also going to be a bonus vesting schedule, meaning if they give you a 10% bonus, you can't keep the whole 10%. So they'll have another schedule showing you how much of that bonus you get to keep depending on when you terminate or surrender the entire contract. Otherwise, if you fulfill the terms, the 5, 7, or 10 years, you would keep the whole bonus as well. Again, just one small component of a fixed index annuity that may or may not be suitable. Always be aware of all the fees involved. As always, educational only.